Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Bull versus Bear webinar. Steve Miley on the call for Trade Aid. Welcome, everyone. We're going to go through our usual regular run through in here today. Calendar, what we've had, what we've got coming up, macroeconomic, fundamental, geopolitical events, what's impacting markets right here, right now. Take a look at those major news wires, and we'll take a look at some charts, what's going to impact markets today, and where can we potentially profit from the particular price points that we can identify in the chart. This is meant to be a guide only, the charts for me, guys. Okay, I'm not telling you what to do or where to trade. It's meant to be simply a guide pointing out where the trigger levels are from my technical analysis perspective, and then also just to give you my underlying view, how I would potentially position. What I don't want you guys to do is to come away from this and just do whatever I'm saying. Yeah, okay. It's just a guide, just showing you my approach. It's just showing you one approach to the markets. I'm not going to try and say buy it here, sell it there, stop yourself out here. You should definitely be short. You should definitely be long. There's always different ways to trade, and also you could potentially be right in both directions, right? You could, if you're trading on a 5 minutes time frame or a 10-minute time frame, and I'm trading on a 3-hour time frame, I could be bullish and you could be bearish, and we can both be right. Okay, so in the different time frames, I'm just trying to show you the kind of slightly bigger picture kind of outlook, as I see it. But please don't take it as gospel, and I can be as wrong as the next man, okay, on any one particular day. Hopefully, in the long run, though, I'm more right than wrong, and that's what really matters for me and for my strategy. But don't come away from this thinking, "Oh, Steve said this, Steve said that," or whatever it might be. Okay, but what I will do is give you a run through in here. So we're going to start off actually on the 5 things to know to start your day. I think it's a good place to start in here. Remember that. So this is the Bloomberg. If I just go and bring up the homepage, so for you guys that maybe are new to the webinar with me, you go to the homepage of Bloomberg. So Bloomberg.com, or the markets homepage. Bloomberg.com/markets. And if you go there, over here on the right hand side, the most important market news of the day. Now, Bloomberg, some time ago now, switched to it being a paid service. If you go and click on a lot of these articles, they're going to show up, for me, obviously you see welcome Steve, because I've got a log on, right? I pay to be able to access all of this stuff. But for you guys, if you don't want to pay, a lot of these articles are going to be shut off. However, what you can do is sign up here for the daily email, okay? And that you get this 5 things to start your day. So it pretty much comes in this form in an email each day. You can click through and watch it, look at it in the web browser as well. So please do think about that. I think it's a really useful resource. It's tailored to your time zone. So if you're in Asia or Europe or the US, wherever you may be, it's tailored to your time zone. So as you wake in the morning, I get this come through, I think about between 6:30 a.m. and 7 a.m. UK time. It comes through. It's in my inbox for when I'm woken up in the morning. It gives me an update of kind of what happened yesterday, what's happened overnight that I might have missed while I've been asleep in the Asian time. So if you're waking up in the US, it's going to tell you kind of what happened in the US day, what's happened through the Asian and European hours whilst you've been asleep. Okay, so it's a good little update. It's free. Why not? Stick your email address in there and you will get that. So it's on the front page of Bloomberg.com/markets. So 5 things in here. What are they telling us today? Well, first of all, we'll look back. Fed. Okay, so the Fed minutes were released yesterday from their most recent meeting. It really did reinforce how they are really focused on inflation now. They're not going to be swayed by potentially the fact that that could tip us into recession. Their fight over inflation. And look, the Fed also made it clear it's ready to prioritize inflation over growth. So if they tip the US economy and maybe global economy into recession, they'd rather keep inflation in control. Okay, yeah, that's an important statement in here. The market, as in when I say the market, so in here, the Fed. Okay, I've already got this article open. Fed sees more restrictive. Fed says more restrictive rates possible. Inflation persists. Return to 2% inflation critical for their employment mandate. Okay, raising rates could slow GDP over time. Minutes show. So they are aware that they could possibly tip the economy into recession. Okay, and look, policymakers increased rates 75 basis points last month. We know that, and backed hiking them at their next meeting job at either 50 or 75, and we know that. And if we go and take a look at our Fed tool, now remember we looked at this yesterday. And this was sitting at, so this is for the next meeting, the 27th of July, end of month meeting, 20 days time. basically 3 weeks from yesterday. Okay, and what it shows us in here is this has risen to 97.5. Okay, before this was sitting down around here around 80. So this is pricing in the 75. Okay, so I think you can look in here. If I just go and you can just look at it here as a historical, and then what we want to do is only look at, okay, so the chances of a, where are we? Target rate probability history. Okay, so if I just go back on that in here. Sorry, so it's 225 to 250. 225 to 250. What's that been pricing in? If I go historical, and we want to click off of all of these, so you basically want to unclick all of these, and we want to go just to the 225 to 250. Okay. Okay, and there it is there. And you can see it's increased back higher in here. Yesterday we were down here at 83.7. Now we're up at 90. You know, the highest it's been in here is nailed on at 95. So you can see it's very much pricing in here, pushing back higher, pricing in a risk of a higher risk now, or a higher probability of it being the 75 at the next meeting. If we go and take a look now at the September meeting, and just go look at the current, this is in here, has also increased in here. So sorry, this is increased over here. Sorry, this one. So now this is saying 275s. Okay, so September, this is decreased. Okay, and this one has gone up. If we take a look at this, so this is looking now for 275s. That's the 300 to 325 mark. Again, if we go look at the historical on that, they should just have one in here where you can clear all, right? God, it's not. So we said 300 to 325. Okay, if we go and take a look at all of these, okay, in here, and what you'll see is in it as an increase now. Okay, so it's jumped back higher, a higher chance now. And it was up here, you know, at one point, up at like 45%. Now it's increased up to still only 12% in here, but an increase now for showing that potentially we could get 275. So the market is now starting to just look at still the probability 75 at the next meeting now, very much nailed on now. And then so that's the July, and then come the September meeting, looking for a total increase from now of 125 basis points, 1.25%. So obviously 75 at the next, only 50 thereafter. Okay, at the September meeting. So the market definitely has reacted to this more hawkish. You have to say it's a more hawkish tone. Very interestingly, really interestingly, the market. When I say the market, I'm talking about the equity markets as a gauge of risk. Okay, liked it. Equity markets were up on the back of this. Yeah, we rallied in stocks. Stocks went higher. You know, initially it was a little whipsaw. We went lower and then higher and lower and then higher. And then once we got that kind of whipsaw price action, the market ended up pushing higher, and we've had a healthy move higher through the session in here, going into the close yesterday. And if we go and take a look at what we're seeing going into this morning, so it was a healthy move back higher. We're up again this morning, about between a quarter and a third of a percent across the Dow, S&P, and Nasdaq. So certainly taking those Fed minutes, the more hawkish tone. The market's actually saying, well, we're kind of now kind of semi-expecting recession. We're expecting a significant slowdown. We've built that into the price. And we like the fact that the Fed are actually going to fight inflation and are not so concerned about growth. Okay, it's sort of counterintuitive a little bit, but that's the message. That's the message we've been getting. And remember, we have had a big shift in other markets. Now, other markets, non-equities, are very much looking on the slowdown in growth, okay, and the potential recession as a real negative. And we've really seen that, and we'll talk about it as we go through the webinar again today. I've been talking about it over the last couple of weeks. There's definitely, since the last Fed meeting, been a shift away from concerns that the Fed were behind the curve on inflation. Now the Fed are telling us we're not only up with the curve, and when we talk about being behind the curve and in front of the curve, okay, the curve is basically what the interest rate curve. That is exactly what this is showing, right? And what it's telling us here is this is the interest rate curve, right? This CME tool is calculated off of the Eurodollar curve, okay, which is the short-term interest rate curve. And what it's telling us is now the Fed Okay, in fact, if anything, up with the curve. And by the curve, I mean the market. What is the market telling us? What is the short-term interest rate market telling us? And what it's telling us is the Fed are up with the curve. The Fed are now in line, or in fact, if anything, ahead of the curve. All right, they're actually even more aggressive, like being more hawkish and willing to be more hawkish, more aggressive than the market is demanding. Okay, and then so the equity markets like that. But what we've seen in the say the FX markets, and I've got a couple of articles in here. One, where are we in here? Dollar King in here. I think is this one. Yeah, look, morning bid, King Dollar. The dollar has been surging higher. Okay, the euro has been the really big casualty, but most FX pairs actually, dollar has lost ground against, say, the Aussie and the pound today. But over the last few days and over the last week or so, the dollar has been super strong. And that is because the central bank has shown its very aggressive hawkishness, the central bank being the US central bank, the Fed, and that is their higher interest rates relative to other parts of the global economy, relative to other economies, relative to other currencies, means that the dollar is more attractive, because effectively interest rates are going to be higher, right? You're better off investing in US Treasury bonds rather than in Australian, for example, or UK bonds, called gilts, or German government bonds, because they're going to give you a better return, a better yield. Okay, and if you want to put your money in a cash deposit, where you're going to put it in the US, because cash deposits are going to be at higher rates than they are in for much of the rest of the planet. Okay, so that yield differential has seen the dollar king. Okay, the dollar really strong. Okay, and that comes from the Fed's kind of hawkishness, and that comes from the concerns around inflation, and also though concerns around the slowdown, that the US is probably better situated, is better suited to weather the storm. And part of the reason the euro versus the dollar, the euro, and we've spoken about this, the euro is getting crushed in here. So we've got an article here from Bloomberg. Euro traders ponder just how low the currency could go below $1. Okay, so we're going down towards parity, right? Option bets suggest that 0.985 could be the short-term bottom. Common currency could gap lower if parity goes. So parity is just a line in the sand. I mean, you have to remember, it's not the lowest point it's been. In its early days, just post conception, back in 1999, EUR USD, the euro versus the dollar, has been below parity. It has traded sub parity. So it's just kind of a psychological level, but nevertheless, you could see a significant move if it breaks down through parity. But the point here is, half the reason that the EUR USD is going low is because of dollar strength. But there's also the concern that the euro and the eurozone as a whole is going to go into potentially a deeper recession because of concerns around energy. Okay, high energy prices impacting even more in Europe. Remember, Europe has to import a lot of its energy, particularly if you look at, say, Germany. It's very reliant, or was very reliant, on Russia. Okay, gas prices are spiking higher. We spoke about this yesterday. Gas prices in Europe, European gas prices spiking higher. Obviously, we know oil has been very high. Oil is coming down in price, but all of that could potentially tip Europe into a deeper recession, a more significant recession than maybe in the global economy, and if we compare it to maybe the US. And then coupled with that, that means the ECB, who are more naturally more of a dovish central bank, they're more likely to err on the side of growth as opposed to inflation. Okay, so being they're more dovish in here, will they be able to hike interest rates, increase interest rates aggressively? Remember, they haven't increased interest rates yet. We're expecting a hike at this next meeting, okay, in July. If they don't, they almost certainly will hike interest rates, but they're going to be limited in how much they can increase interest rates, because potentially Europe's going into a deeper recession, and by de facto they are also more of a dovish central bank. So they may be less aggressive on interest rate hikes, which again means euro weaker. Both the fact that there's potential recession, plus the less hawkish, the more dovish central bank, means yields lower, interest rates lower, less attractive to invest in the eurozone, to park your money in the eurozone, in the euro. So again, EUR USD getting crushed, aiming at parity and potentially below parity. So the FX markets are saying one thing kind of stuff. They're more focused on the differential in the interest rates, the fact that the Fed are going to be more hawkish. The equity markets are saying, okay, we're happy with the Fed being more hawkish. We'll take that as a positive. positive. We're going to take the Fed being more hawkish, more in for the fight on inflation, getting ahead of the curve. And so equity markets reacting positively to that information yesterday, even though it could tip the US and maybe global markets, global economy into recession. We'll put up with that, the equity markets are saying, as long as you keep on top of inflation. So they've reacted positively to that inflation news. I know I've laboured this point. I know I've spoken about it recently. I think it's a really good point to make, though. I keep saying, just as a little segue in here, guys, if you're live on right now, can you say hello? There's a little chat box underneath the video streaming. Okay, you can go into that chat box, just say hi. It's nice to know that someone's listening at the other end. Oh, we're getting a couple of little highs coming in. And if you've got any questions about any of this, is there anything you want me to focus on? If there's anything you want to look at on the charts, if you want me to focus on oil more, if you want me to focus on gold, if you're trading something that I don't focus on, if you're trading the currencies, you say, Steve, you focus on oil every single week, okay? Every single day, you focus on gold, you focus on, I don't know, obviously we focus on the S&P and the NASDAQ because most of you guys are trading there. Every now and then I'll dip into bonds. Morning, George. So we're getting a few people say hi in here this morning. So if you do in here, Yuri, hey, if you do want me to cover anything, you want me to look at anything, throw it in there. Hey, Clinton. So yeah, throw it into the chat. Ask me a question. I'm more than happy to react, right? Rather than me just splurging out everything that I think is important. Yeah, this is what you might think is important, what you need some extra information on. So please demand it. That's what we're here for. More than happy to do that. If you've got something you want to, if it's not actually in the moment, if you think about it later on today, ping me an email, steve@tradeday.com. I'm more than happy to cover it in the webinars. Even if you don't catch it live, you can catch it on the recording. Right, next. I've got a little bit off track now. So Fed minutes, we're concentrated a lot on the Fed minutes. So that's what's going on. Oh, the other thing I wanted to say is about commodities as well. So commodities as well, getting crushed on the downside. Double reason for that. One, recession, potential recession coming up, growth slowdown, not good for commodities. Commodities, where's my article on commodities in here? Commodities lost 20% across the board since June's peak amid recession fears, right? So one thing, commodities selling off because of recession fears, global slowdown. You need less commodities if you're going to produce less stuff, right? If you're going to produce if China's making fewer, I don't know, widgets or whatever China makes that we import over here into the West and we all consume, right? If China's doing less of that, they need less inputs to that, right? So commodity prices, less demand, less growth, lower growth, less demand, lower commodity prices. Those are the inputs to making all of these, all of the goods and services that we, or for the goods, not the services, for the goods that we consume. Okay, so commodities are plunging lower. If you look at what it means for stocks, though, well, if you're if you're looking at the fight against inflation, that's kind of seen as a positive. Look, the pullback could bring relief to consumers hit by inflation. Part of the sell-off that we're seeing look, the Bloomberg Commodity Spot Index tracks 23 energy, metal, and crop futures contracts, lost more than 20%. Interestingly, it's got anything in here about two of the big spikes higher have been, as we know, energy, right, and food, okay, that have been feeding into highest inflation in 4 decades, in the global economy, in the UK economy, certainly in the US economy. Okay, has it got anything in here particularly? No, but we have seen a significant move back lower in food prices. Okay, the inputs to food, so like the likes of wheat, have come off their highs. They spiked higher, come off the highs. We have still seen gas prices, as I mentioned, and that's partly because of the reason that Europe and the euro are under negative pressure because gas prices are staying very high. Like anything, gas prices are pushing back higher. They spiked aggressively higher when we had the Ukraine conflict, when the invasion happened back in February, March. We saw a massive spike higher in the European gas prices. Okay, not so much on US gas prices. Okay, less impacted because obviously US supplies its own gas. But we saw a big spike in European, UK gas prices spiked higher. They came back down after that and have been actually trending lower up until about the last week or two, and they're spiked back high again. Real concerns around higher gas prices. So that's part of the reason. But if you look at what oil has done, oil has plunged lower, right? Brent oil plunged lower in the last. We put a topping pattern in. We spoke about the topping pattern about 2 weeks ago. A topping pattern went in oil, and then the last few days we've had an aggressive plunge lower in oil. Again, that takes off some of the inflationary pressures, and what that means is that's actually kind of, you could view that as being positive in here for equities, okay, in the longer run, and maybe take some of the pressure off of the central banks if this helps in the fight of inflation, because if commodity prices are coming lower, then and food prices are coming lower, then that means the inputs to the inflation numbers are also going to potentially start to roll back down. Right, what else we have? This is very UK centric, but we've had a kind of a political storm in the UK. It's not going to really impact anything you guys do in here, but it looks like our Prime Minister Boris Johnson is going to resign today. Well, I think he may have done it whilst we've actually been on the webinar, or just before I came on the webinar. But that's pretty much nailed on that that's going to happen. So we have now a leadership fight for the actual Conservative Party, who are the currently in power, and then whoever wins that leadership becomes the new Prime Minister. So we don't vote for the new Prime Minister. That's how it works in the UK, for those of you who don't know. We're going to get that happening over the next few weeks. But it's really not. We're seeing a slight rebound in the pound, but to be quite honest, a pound versus dollar. But you've seen that the dollar is kind of slightly weakened across the board against most currencies this morning. So it's not so much the pound up; it's more a dollar down. The pound has slightly rebounded against the euro as well, but obviously, as we know, the euro is very weak. The other thing we saw yesterday, treasuries went extended declines. Okay. So yields rising, so lower treasury prices. We're going to take a look at the chart on that. Let me bring the chart up. So here's the treasuries in here. So treasuries in here went lower in price, higher in yield. Okay, now they have been tracking up. Okay, up in price, down in yield. Okay, but reversed that yesterday. Lower in price, up in yield. Why up in yield? Well, because you have because we have in here lower in yield, because the Fed has told us they're going to be a little bit more hawkish. More hawkish, yeah. Potentially higher interest rates. Potentially higher interest rates equals lower bond prices, higher yields. Remember, there's an inverse relationship between bond prices and yields. Bond prices go down, okay? Yields go higher. Remember, yields are just long-term interest rates, okay? Okay, there you go. Okay, I have a question coming. Do you interpret yesterday's weak breakout of a falling wedge by the Nasdaq in light of these or economies? But do you think to interpret the weak trend line breakout by the Nasdaq out of falling wedge in the day time frame in light of the pressures of recession fears? Okay, I can't quite, for some reason. Do you interpret yesterday's weak breakout of a falling wedge by the Nasdaq in light of these recession fears? I can copy an image in, but how do you interpret it? I'm not sure if you can put an image in. If you can put an image in, great. Otherwise, I'll see if I can recreate what you're talking about that in that falling wedge, okay? I'll come to that when we come to look at the charts, okay? I can't see who that's from. Is that from you, Clinton? You can answer, because it's just when it comes through in the chat in here, it's a little bit kind of scrunched up for some reason at my end. But I don't know why that is, but yeah, I can certainly look at that when I come to the charts, no problem. Okay, let's go back to 5 things to start your day. Authorities in Beijing are considering another play to shock the world's second largest economy, allowing local governments to sell 1.5 trillion yuan. So again, a stimulus in here. Stimulus from China, a positive. We spoke about the treasury decline in here. What's coming up today? Well, let's go and take a look at the calendar, actually. So the calendar in here, I haven't had anything of too significance. We did get German industrial production. Remember, the powerhouse of Europe, missed expectations. Another sign of the European slowdown, okay? So that's a negative, okay? Echoing what we've seen more recently and the concerns in the market. Today's main focus is going to be, where is it? ADP, right? Where's ADP? Why is that not on there? Thursday, right? Yeah, ADP was today, right? Why is it not showing up on here? I'm pretty sure we've got ADP today. Actually, quite shortly, in 20 minutes, I think, but I don't see it on there. Let me go and look at another calendar. I have another calendar in here that I can show you. Where are we? FX Street. Let me go and look at it. I'm pretty sure we've got FX Street. I don't know why it's not showing on the investing. I'm pretty sure it's ADP day today, because it's delayed a day because of the Thursday. US initial jobs. Oh, I don't see on there. Was ADP yesterday? Did I get that wrong? Was ADP yesterday? Maybe it was yesterday. Don't see it on here for today. No, jobless claims. No, EIA. Okay, maybe I got that wrong. Maybe ADP was yesterday. Maybe I missed that, guys. Let's go back to the calendar in here. So today, then, nothing really of significant note. What we're going to be looking at, if you're trading oil, we've got this oil data later in the day. Waller speaks from the Fed. That's at 1 p.m. Bullard also from the Fed. Let's see what they've got to say after we've had those meeting minutes. So those are probably the standout events if you're trading oil, obviously here. Okay. Right, that's the calendar. I've gone through most of these already, and we've had a long macro lecture from me today, so I won't keep bashing on the macro side. And I'm just wary of time in here. So, Fed sees we've already spoken about the Fed. Fed in here again. Fed fears of entrenched higher inflation fuel big rate hike minute show. Yep, we've covered that. We've covered what the bonds have done. Stocks rise as inflation worries ease. Pound jumps. Okay, so inversion in the yield curve. Okay, whoops, we don't want to listen to that. Inversion US yield curve signals fears about recessions. Yeah, the yield curve already has reversed previously this year, so we knew that we already had that kind of signal. Okay, and yeah, chip makers are doing well. Tech's doing well. Nasdaq led us higher yesterday again. Again, growth stocks do better when we're in a lower yield environment. However, we did go to higher yields yesterday, but we're still getting that boost from the chip side. Commodities are lost. We've already spoken about that. We're talking about the dollar being king, the euro being week. We've already gone through that. And where are we this morning in Europe? Or Europe, we've had a bit of a catch up. Remember, Europe closes much earlier in the day. Okay, it's Europe cash markets, even though the futures markets stay open pretty much throughout the night, and they stay open in here with the US markets until the closes in the US at 4 or 5 p.m. What we see is around lunchtime, US time, 12, 1 o'clock, around that time, 1 o'clock really, we see European cash markets closing. Okay, so they're like 4, 5 p.m. European time, 5, 6 p.m. in Europe, 4, 5 p.m. UK, depending on the markets you're looking at, and that's around lunchtime in the US. So given we got the rally late in the day yesterday, post Fed going into the close, the little spike high we had in the stock index in the US, Europe playing catch up this morning. So these are the cash markets, and they're playing catch up. So about between 0.5% and 1.25% up this morning, but playing catch up on the moves that we saw in the US. But the US is up as well, a little bit as well. So partly higher in the US, having had a decent closes into yesterday. Right, charts. I'll start with the NASDAQ. And again, I can't quite see because it's a little bit, I think it is from Clinton. It's come in a few times. Do you interpret yesterday's weak breakout of a falling wedge by the NASDAQ in light of these recession fears? Yes. So I think, as I said before, I don't think the market cares about a recession in here. What I think the market is looking at, when I say the market, I mean the equity markets. I think the market is in here now looking at the fact that, so on the daily chart, so I'm assuming in here, let me get rid of all the old tools. I don't know which, there's going to be like probably a couple of options on wedges in here, but you've certainly got, say, this line here, right? You might be looking at this one here, kind of an obvious one through here. So in here, so we kind of already pierced that. I would keep this one in. Personally, this one is, I think, the fact that you got here, you get the touch and rejection here last week. Okay, then the market comes lower, then it rebounds and breaks. Okay, and so it did break yesterday. I think it's a decent break yesterday. We went right up to it on, what day was that? I guess this is the one you're looking at, right? I think there's Clinton who's asking this. I can't see. Say, because it's it is you, Clinton, right? Yeah, I see that now. It's a little bit, for some reason, it's squeezing up on the text as it comes in, but I can see it. I think this is the line. You could redraw that line, obviously, through here. I think that this is bad analysis for you redraw it. If you redraw it through there, look, we're only just pipping through it, but that's bad analysis. I think this original line, I'm going to get rid of that one there. I think this is original line. And if you look in here, comes off here, you get touches here, and then the market moves impulsively away from it. So here it tells us you've got multiple qualifications that this is the correct trend line. You draw it off of here and off of this point here. This is so I've got it the high from the, so where are we here? This is the 5th of April, and then the high from the 3rd of June. And then you get reinforcement here on the 8th of June. And again on the 9th of June, the market goes up, fails, goes up, and then impulsively moves away. So it respects it. Then you get the test here on the 27th of June. The market pushes above, fails. You get this kind of doji candlestick in here, that one there, as it pierces. And then you get an impulsive move away. And then not yesterday, Tuesday on the 5th of July, On Tuesday, we get the push up and we stop right on the trend line. And then, so the market's still hesitant. We could have then through the Fed, didn't want to break it ahead of the Fed. And then through the Fed, you could have rejected it. It could have been another one like this. It could have been a replication of what we saw here at the end of June. And it could have fouled back lower if the bears wanted to take control. The bears didn't take control. I mean, it is, you have kind of got this wedging as well, you could argue, right? If you want to put this one on the bottom, but I don't think that's even that relevant, this one in here. You do just have a higher, low now. That's all it's really telling me here, is that you've got a base going in. This is a base building for me, okay? And if we zoom in, and I think that break, I think, for me, I'm a technical analyst, right? Even though I've run through all of that stuff with you guys, I'm a technical analyst, right? And what this is telling me is this is reinforcing what we're seeing anyway. And if we go into the 15-minute chart, what we saw previously back here, and we spoke about this, is this kind of quadruple bottom back over here. So at the lows, okay, back in here between the 30th of June and the 5th of July, and going back to the daily, so these lows in here, we had a quadruple bottom going in on the intraday chart, okay? So we go in here, you get this quadruple bottom. Obviously, we've got you've got the deeper lows over here. And these lows here went in respect to these lows over here as well, okay? So the market in here certainly respecting, let me get rid of this fib, it's irrelevant there. The market kind of respecting this support area here, you get this quadruple bottom going. So it already signaled a base, and then we get that surge back higher up. This was on the 5th of July, post Independence Day. We come back in, boom, we get through this high and this high, respected these. You can see this high here on the 5th of July, early on the 5th of July. We pushed higher after Independence Day. We pushed higher in the pre-market session. This was in the Asian session. And then the market fouled lower aggressively and then really strong rebound again. And it took out that high there. So then you've got this quadruple bottom goes in. And then that reinforces for me what you're seeing here with this on the daily chart of the break of the trend line. For me, this says we're playing it from the long side, for the next few days. And it wasn't an aggressive move yesterday. If you look at the daily RSI down here, massively far from overbought, right? It's got plenty of scope to go higher over the next 2, 3, 4 days, right? Has it got scope to go higher today? We'll go to the 15-minute chart. Well, we're far from overbought. Let's zoom out a little bit in here onto I'm going to go 1 hour chart first of all. On the 1 hour chart, are we overbought? No. And why are we not overbought? If you go back to the daily, because we didn't really move. It was a really non-aggressive move yesterday. The move didn't really come. It didn't even come on the Fed, right? It came quite a long time after the Fed. You get that move higher. Let's have a look at actually the timing on it. So the impulsive move, right? So where's the Fed? This is my time, right? 12, yeah. This is set on my time. So where's the Fed yesterday? So here's the Fed here, right here. That's bang on the Fed, okay, and then it doesn't come for half an hour to an hour later. You get the actual move high. No, actually, it's not that far after. Actually, you get the move, but then it retraces it, and then it's a strong close. Yeah, so it's a decent close, right? It is post Fed, and it does it, pretty much, within 30, 40, but it's not bang on the Fed. It's after the Fed. It's a bit of a slow burner, but then you kind of retrace overnight, and then it's back up, and we're sitting pretty today. I think it's sitting for the next move higher. Yeah, I think the market's going to take what the Fed have had to say. They seem to be taking it quite well. Europe's taking it quite well. Europe's been in the real doldrums over the last few days in here because of all these concerns about gas. So for me, this and Europe's responded quite well today. I can only play this from the long side. So I don't think you don't worry about recession. You think, wow, the positive in here on the macro side, you say, well, the market's telling me the reaction of the market is we're more worried about inflation. We're happy that the Fed are focusing on inflation. And okay, if recession comes, it comes. The way you definitely stop it is you need to get inflation under control. And then hopefully you don't go into recession, right? And then you can cut. The Fed, if we've looked at the Fed tool, right? The Fed's online to cut rates, here in May, June next year. That's what this is telling us, the curve in here. Look, the peak in rates here in May, 325, 350. By the June meeting, expectation of rates 325 to actually 325 350 still. July it's more 300 325. So somewhere next summer, May through July, we're expecting the Fed to start cutting, okay, cutting rates. So back to the charts now. What I'd be interested in as well though, okay, so you know what, I've been doing this all on the S&P, I think, haven't I? No, I've done it on the NASDAQ. I have been doing it on the NASDAQ. Here's the NASDAQ, yeah. And then there's the 1 hour chart on the NASDAQ. Sorry. There's the Nasdaq. There's the quadruple. Yeah, there's the move on the Nasdaq. Let's go and look at the S&P, because obviously the S&P in here, if you draw the same line, it's not. We're nowhere near that. The Nasdaq's leading us back higher in here. If we look at what the S&P has done, we're nowhere near. So the same line would be here through here, right? So where did we draw the line on the Nasdaq? We had it from the high of the 5th of April and the 3rd of June. Okay, if we go and take a look at the equivalent in here, 29th of March actually doesn't really set up the same. There's the 5th of April high. And then it doesn't set up because of this high. So the setup's different, yeah. So you're getting different trend lines in here, but we're some way from breaking this trend line, and it's not as emphatic here for the S&P. Really, the Nasdaq, does it's got the higher beta. It does lead in some ways, but ultimately, what's the benchmark? The benchmark's the S&P, right? So we want to see the S&P doing well. So if you trade these, just a little heads up, guys. Again, you've got the same like quadruple bottom on the S&P. You've qualified that now by pushing above the peak here. We spiked above it on the Fed. Look, that peak there. We spiked above it on the Fed. We retraced and we're back above it. We're holding right on that line. We want to keep above this peak in here, okay? That peak was 38.57 3/4. We want to hold above that peak in here going today. And I think, the S&P could play a little bit of catch up today. And that would then obviously help the Nasdaq go again. Okay, hope that answers what your question in there, Clinton. Let me go and have a quick nod because I'm just conscious of time. Quick nod to the commodity markets in here. Start off with oil. So we are seeing oil having had that plunge 2 days ago, another sell-off in here yesterday, and then a rebound, trying to rebound and put in. I think this is a corrective rebound. Bigger picture, definitely damaged. We spoke about the topping pattern went in. Bigger picture, the threat is lower. Going into today, however, what do we see? You had this we spoke about this flag pattern yesterday, right? We had the flag pole and the market broke, and now we're flagging back higher. I think there's a little risk we probably push a little bit higher. The market's probably going to say, well, equities are going up, right? Maybe the equities are not concerned so much about a recession. I think there's risk. Bigger picture, if I'm a swing trader, I'm looking to sell into this rebound because of this chart, because of the daily chart. I'm looking for a move up into here to sell into if I'm a swing trader. If I'm a day trader, what I'm looking at is, well, you know what? I've got higher high, higher low, higher high, higher low, higher high, another higher low, and now another higher high. I think we can push back up towards the peaks from yesterday, so up towards 101.5 to like 102. That's where, if you're a swing trader, you're going to be wanting to sell it. For the day trade, there's probably a buck or two to the upside, $2 to the upside before it rolls over. However, if it starts to undercut any of this support on oil, you got the support line here, that's an important line. If it starts to cut down through there, like below 98.30, it looks vulnerable again. Okay, but for now, I think slight upside bias on oil. Going into today, gold plunged. This is the daily on gold, plunged over the last 2 days. This is with dollar strength, okay? Even though we're kind of, risk off. We're kind of risk off. We're not risk off, right? We're risk off because we've got recessionary fears, but equities are doing okay. So actually, we're kind of equities up, so risk on. So then gold down and dollar up, okay? Dollar up, inverse relationship between gold and the dollar. Then we see gold down as well. As we know, if we go and look at the dollar today, the dollar's having had a surge higher the last 2 days. Is the dollar index now has had a little bit of a setback, a little bit of a pause. Hence, you're seeing a little bit of rebound here. 30-minute gold now. Now I'm jumping around a bit. There's the two moves lower. Boom, pause, boom, pause. I think you've still got to play it from the short side though, right? Going into today, I would still be playing this from the short side. It's not done nearly enough in here. So waiting, but I wouldn't want to sell this until we actually get a breakdown through support. So gold could easily track a little bit higher in here today. But, if it breaks down through like that trend line there, you can see that it's been there. It's a good trend line off the low, off this low here. You get a qualification, third touch, fourth touch. If it breaks down through there, so that's going to be somewhere around 1740. Certainly if it goes through this little overnight, the more recent low, 1738, down through 1740, 1738, gold looks vulnerable again. Okay. All right, guys. Thanks for the interaction today. More of that, you guys that are on. So anyone else, if you've got a question, fire it through. I'm more than happy to take a look at it. Thanks for the interaction. It's good today. Enjoyed that. So I'll be back with you with another Bull vs. Bear webinar for TGI Friday, the 8th of July. Until then, take care, stay safe, and have a great trading day. Bye.